Good. Well, thank you very much. So I'm definitely stepping up to the macro scale after that very micro dominated previous talk. Yeah, so I'd like to look down and give you some thoughts as we see unconventional oil and gas, shales and tight gas globally. I want to focus in on the US success case. It is a success case. It's been remarkably impressive. Can we repeat this globally? We'll touch on that. And then ultimately, what does it mean for global oil and gas production and therefore prices? And prices mean share price. In my world, that means the valuations of share prices and company valuations. So, I mean, it's a very significant discussion point at this point in time. It's going to dominate most of my time, I'm sure, for the next couple of years. I think, everyone knows conventional exploration success rates. I mean, it's useful just to really look back over the last 110 years at conventional. So looking for those good quality reservoirs and those high quality hydrocarbons. The green line here being the just the wildcat frontier exploration success rate has improved over the last 20, 30 years, but we're still running at about 33%. So 1 in 3 wells is coming in. So the demand is definitely there to go out and seek other resources, because the next chart will show you what a poor job, what a weak job this particular part of exploration is doing in meeting consumption of oil and gas. So that's the chart I'm mentioning. Again, these are conventional, what we typically described before as conventional hydrocarbon discoveries through time. We have shown this chart before, but just plotting it with blue, which is natural gas demand every single year, and it's rising, as you see. It took a small dip in the recession here in 2009, but is firmly back on track. Oil demand does get knocked off slope every recession, but it's been continuing and it's starting to increase again this year in 2010, 2011. But here is the track record of that 1 in 3 conventional exploration success rate. And this is all on the same scale here, so you see this very material gap here. So the appetite, the incentive to go out and monetize and search out unconventional resources is definitely very apparent. So, I mean, what's changed in the last 5 years? Well, as we've heard this morning, it's all about the horizontal drilling and hydrofracturing and its application of that technology into the source rocks, into the shales, and looking for oil and gas. Primarily, it's been gas in the last 12 months. Certainly in the US, it's been much more seeking out the oil, which Neil spoke about this morning. So, it's useful. I mean, just look at the impact this is happening in North America. If you look back at 10 years of reserve estimates just for natural gas, back here at 1,500 trillion cubic feet, you see that how the brown line has been moving up. It's a constant set of data points that we get pretty much every year. Or some of the other forecasting agencies, which we've seen evolving in the last couple of years, talking about 3 up to 4,000 trillion cubic feet of unconventional gas resources. So that's where you can get these numbers about the US being independent on gas and actually exporting natural gas to other markets. I mean, that's the big debate today. Will the US start exporting this stuff and become like, Trinidad, Egypt, Qatar, these types of major gas exporting? This is a very big question, certainly at the moment. But again, there's competing industries that want their hands on this natural gas. The chemical industry, the fertilizer industry, the manufacturing industry, they're all eyeing this resource base, and they're very happy to see the depressed natural gas price you have in North America, and they want this to be fully kept inside the North American continent to keep that price low. So there are conflicts here about what to do with this significant resource pie if it is actually available. Other benefits of the US success case is actually employment, and you see sort of petroleum engineer enrollments spiking up over the last 5 years as well. After the drought period here, just all aligned to this incredible activity level which is across the US. I mean, North Dakota has a 0 unemployment rate at the moment. The rest of the US is at 9.1%. Everyone's working in North Dakota, where the Bakken Shale is just pumping out oil left, right, and center. But so what's really happened here? You have to call it a revolution. I mean, it is, as I said at the beginning, very impressive. The red area at the top is the ramp up of natural gas production from shale, from the Barnett, and which we heard about, the Haynesville, the Marcellus, and that's how it's actually growing US gas production, which was actually in decline up until 2004, but it's increasingly becoming 10, 15, 20% of total gas production. And this is what it's, I mean, this when I always talk about the impact on prices and valuations, this white line is that US natural gas price. And ever since we got up to this level, it's caused that gas price in North America to collapse and never recover. You know, we at Bernstein actually are quite optimistic that there are certain drivers emerging to lift the gas price over time. A lot of the companies making these investments will also be believing in such a forward outlook for natural gas prices to make these investments fully economical. But it's been a very long haul here of $4 per 1,000 cubic feet of natural gas prices after the industry was very used to prices 3-4 times that. So it's simply a function of this. This is what it's doing to prices, and that is causing, but then that's also leading to another successful attribute of the US unconventional gas industry. It's flexibility, its ability to jump onto the liquids, the oil shales. And this is the rig count. This is a number of rigs in the US drilling horizontal wells. So fracking, horizontally drilling shales and tight reservoirs. Yes, it took a little bit of a dip through the recession, but firmly back on track with 1,000 rigs drilling horizontal wells today, continuing its ascent. And when you dig into what they're actually drilling, you can see how the black area is more liquids, oil-rich shale gas, or no, shale plays across North America. So the gas price is depressed, the economics are challenged. This is just how successful this industry just moves those rigs onto the more liquids prone or oil shale areas and increases the drilling from that particular resource, because the economics are obviously much better. So this obviously is a driver, therefore, of a rising gas price. You can imagine if activity levels are slowing on gas, I mean, eventually production will slow, inventories will reduce, and prices typically respond to those types of drivers. So that's one of the reasons why we think the price can rise, but it's having a very dramatic effect for the last 3 years. So, and again, it's also just useful to remember some of these numbers. We do have 1,000 rigs drilling horizontal wells. You have 8,000 companies. You probably have 500,000 wells producing natural gas in the US today. Maybe 10% of those are pure shale gas wells. So, there's very big numbers, and you have to think about those numbers when we think about rolling this success case across to Europe, Africa, parts of Asia, South America, because those sort of numbers just don't apply yet. So there's various estimates coming out, but one that was recently published by the US EIA has focused on all of these basins around the world. And you can see most of those regions I just mentioned, Africa, Australia, China, Europe and South America, all estimates coming out about how big the oil and gas could be in all of these basins. And that's why there's some very deep concerns here about, could oil prices collapse as well? Could gas prices stay at 4 forever? Could the US be exporting, and there's just so much oil and gas around that commodity prices are going to stay very soft for a meaningful period of time. So, it's definitely the most topical debate we have in the sector today. I just wanted to not go through any of these numbers, but if you look at the proven, back from that map, they've come up with numbers here, which and as Neil was talking about at the moment, and Statoil this morning, there's very limited data in any of these countries outside of North America in terms of commercial flow rates, the amount of gas that's coming out per well. But some of these estimates are incredibly high here. Global proven gas reserves, 6,600 trillion cubic feet of proven gas reserves. Just the recoverable shale gas reserves from some of these countries, again, equaling that number. So, these are sizable estimates, but based on very limited data as we see today. I think if you go down through some of these numbers, you will see that North America is, a big part of that. So is China, and I want to talk about that. So is, in terms of Europe, it's Poland, it's parts of France and Scandinavia. So those three core areas that make up the European portion. Then in China, and then in South Africa, and then down in Argentina. So those are the countries we've heard discussed this morning. That's where the biggest reserve estimates actually lie. And that's therefore our job to focus on that and say, how quickly can that gas come out of the ground and impact oil and gas prices? I think it's, it is interesting to look at some of these forecasts and the sort of high maturity regions are very well mapped. But then, our job is to go match that with company activity. And, the bigger companies are working some of these areas. This is the Scandinavian alum shale that's been highly speculated about for Europe. It's a big part of the European reserve estimates. Only Shell at the moment have been drilling down here, have drilled 3 wells, have actually said that they had very mixed results from those 3 wells. And actually, even though they had taken 3 years to build up this acreage position here, mapped here, they've actually exited that play. So, Europe is, most of the rest of the world is very, very early. These are the types of indications we have to use from corporate activity, from those early steps being made. Doesn't mean it may never work, but it's always, from our experience, looking at technology, looking at new plays, it's always good to see a major, let's say, validating the certain idea. So I think that's interesting. Just if you look at the Scandinavian alum shale, maybe it's not as viable as projected in some of those early estimates. China is the big one. I mean, everyone just says, Europe has, we've been here discussing last year about the problems in Europe with population density. We noted last year water issues, rig issues, et cetera, et cetera. You're seeing those coming through some of the company decisions. None of those things are perceived to be a risk in China. People just imagine China has 2 big shale gas basins, and if they need rigs, the perception is they will be built and built for very, very quickly. And that's what we attempt to include here in our Chinese gas production outlook, inclusive of some of the shale gas. The problem is, it's not just about building rigs, it's about bringing in water and bringing in pipelines. Pipelines across some of these continents, you just have to remember, are significant scales, significant sizes, which we'll see in a slide or two time. But at the moment, based on corporate activity, based on plans by companies, we can incorporate some small portion of shale gas supply into the Chinese picture, only getting us to about 2% of their total production. So again, that's not yet significant for us to be overly concerned about prices being depressed and compressed in that part of the world. And that's, I wanted to talk about infrastructure. You don't need to zoom in on these, but just if you take a look at, this is just gas pipelines, that intense density of pipelines in North America. Pretty much you can connect up your shale gas to a pipeline in very close proximity to the play that you're in. You can get that to market, a supply and demand driven market. When you start to look at some of the other regions which have large estimated unconventional oil and gas resources, the picture is very, very different. And this is China. Yes, we have the east-west pipeline coming from Turkmenistan over to the coast, but as you go down into the major shale gas basins in the southwest, really a very limited infrastructure set in order to bring that gas up to the coastal populous region. So, it's these, and same thing in Australia. Everyone looking today in the center of Australia for shale gas as well. We're always going to stumble into the infrastructure problem. That's what you're hearing about in Iraq today. Last year, they were talked about 11.7 million barrels per day of Iraqi oil output from 2.5. So they've lifted it 10%, and now you listen to everybody that's operating there, and the one resonating complaint is infrastructure, pipeline exit, throughput. Again, that's that step function which always seems to slow down any large-scale development. So I think we're going to, this will be a very important part. Same thing in India. There are some coal bed methane and shale gas prospective areas in India, but 2 major natural gas pipelines in order to ship that around. So, but obviously, I mean, it is having an impact, and that has implications for the oil price. And could the oil price do the same thing as the natural gas price has done in the US? This chart just shows you all of the production of oil outside of the OPEC nations. And, you know, if you think about the last 2004 up to 2009, that's when we had the big oil price jump from 40 to 150. You know, the rest of the world was doing nothing. Supply was struggling to keep up with rising demand. And that just compounded the acceleration in the oil price. But that's because it takes 4 or 5 years to bring on large-scale supply. And all that's happened is that supply has started to come through since 2010 and will keep going to 2013 in that next phase of supply. But a big part of this is actually US onshore shale, which you can see here. This is from the late 1980s, the declining US oil production base. And then just look in the last 3 years, the green area being the onshore, starting to increase again. So, you know, that flexible rig has just been transfixed onto the oil shale, and it is having a positive effect, which is having a part of this increase here in non-OPEC supply. So, you know, it's certainly something for us to be cognizant of when we're thinking about where the oil price can go. It's not the dominant feature in here, so I wouldn't say it's as successful as natural gas. There's actually quite strong production in Russia and Mexico at the moment, which is also causing some of this. So, you know, obviously it's our job also, therefore, to look down on North America and say, you know, could that prior slide, I mean, how much could that green area actually go up? And we have to monitor all the activity that Neil McMahon's doing and all, you know, whether it's Statoil or every other company. We have to try and put all that together. And this is just, you know, it's the Eagle Ford and the Bakken. The two things you heard about this morning are the core areas of oil production. And what you see is, you know, yes, we are going to have quite meaningful supply growth over the next 5 years. Inside here, there's all these wells are declining, you know, after 60 days, they're declining 50%. But if the clearest indication for us, the best leading indicator we use is the rig count. You know, if you look at a 100% rise in the rig count, you could see 150, 200% rise in oil production 1 or 2 years later. So that's why that rig count number of 1,000 rigs is really important, and we have to think about how fast they can grow that rig count, because it is a manufacturing process, and that's what's going to drive supply. Without massive scale growth in rigs, then the declines in each of these individual wells starts to pull through. And remember, so we're talking about 1.2 million barrels per day of oil and gas just out of the Eagle Ford unconventional play by 2015. But remember, that's on top of a 6-7% decline rate on the rest of the US production. You know, remember, 5 million barrels per day falling at 5-6% per day, and you are growing this. So we are getting some growth, but it's not like the US is starting to do this again. You've got serious declines that you're always battling. And unless a serious expansion in the rig count is happening, you can actually get a good grasp on supply outlook, at least on, you know, on a 5 and 10 year view. You know, even with the red line just shows you the actual oil content, because there is oil and condensates, natural gas liquids. So we are talking about 1 million barrels per day growth, but that's, I mean, in itself on a 5.5 million barrel per day base, very significant and a crucial part. But remember, that's 1 million barrels per day on a 90 million barrel global oil production base. You know, it's not the case of the US, where we had 10 to 15% additional onto that market. This is a 2% supply increase on the global oil picture. So it's not as impactful yet in terms of oil supply. And the other thing is, I mean, we are going to hear about a lot of companies going into shale gas, shale oil plays. They're learning, everyone's learning about it, and materiality in companies is not yet big enough. But it's always, you know, that's why we do a lot of work to say, where is the sweet spot as well? Because it's not just a sweet spot in terms of geology, but the sweet spot directly feeds into the economics. So in the Eagle Ford, you know, there are obviously many thousands of acres by county across the Eagle Ford play. But this chart shows you what's called the development cost per barrel. So you can, I mean, that's a significant range here from about $20 per barrel up to sometimes $110 per barrel to develop your incremental well. So, a lot of these areas wouldn't be a great decision if we saw companies taking large positions in here. And especially, and as Neil was saying this morning, this is light sweet crude oil. It's coming out of the Eagle Ford, it's coming out of North Dakota. And what happens in the US is all that supply goes into a measurement system in Cushing, Oklahoma, where you get the West Texas Intermediate pricing point. And that price is thoroughly depressed at the moment. So that price is actually, even though you might see $110 oil prices today, the US mid-continent price is actually $30 less than that. So it's not just, it's a lot of these wells that become quite marginal as well. A lot of these Eagle Ford oil shale wells that you have to start to raise question marks at. Yes, these areas are obviously very highly attractive, really impressive margins if you can get in here, but you have to pay $25,000, $30,000 per acre in order to get in there. So it's not, it's not just a big open land grab. Production is going to keep rising, and oil prices are going to collapse in the same way U.S. gas prices did in 2008, 2009. What I'm also seeing, therefore, is other big producing nations like Russia is starting to talk about this as well. So they're talking about, we should be using this horizontal drilling technology. We should be hydrofracturing our wells and boosting supply from deeper, tighter, and the Bashanov Shale as well. Rosneft is starting to talk about the Bashanov Shale at the moment. But again, you have to listen. You have to take that story, but then you have to try and say, how achievable is that strategy given the current constraints on infrastructure? If you start doing numbers here, this is Lukoil, another, a large Russian oil producer. They have a clear strategy today to grow, and over the next 10 years, they want to be growing at probably 2% per year in terms of oil production. And the mechanism to get there is to drill horizontal wells, fracturing, and taking on some of their, into the shale and into the tighter portions of their existing reservoirs. The problem is, in Russia, you can't drill very many horizontal wells per rig. You have a short drilling winter period. You also have very low complexity rigs. 80% of the rigs are over 30 years old. They don't have the horsepower necessary to go down to 5-6 kilometers and turn horizontally. And you would need significant numbers of rig increases. Lukoil will drill 100 horizontal wells per year. They would have to go to 2,500 horizontal wells per year in order to achieve this strategy of oil production growth, which would have implications for global oil production as well. So given we know that there's a company in Russia building rigs called Uralsmash, they actually build 30 rigs per year, and they're the principal supplier of new rigs in China. It's tough for us to say, okay, this is going to happen. We have to stand back and say it's not actually achievable, and we have to take that particular view. Yes, you can import Chinese rigs, but when you talk to the Russian companies and you see the quality of those, they're still not up at the optimum quality required to roll out horizontal drilling, hydrofracturing programs. So that there isn't a clear solution here. And also the Chinese rig imports are being, let's say, held back so that local governors are protecting some of the indigenous construction companies. So it's not, I think it's important when we see all these big reserve estimates to look at all the various obstacles or the alignment that needs to happen to bring this supply out. And it's very difficult, it's very challenged. So therefore, on our point of view, we have to factor all of this in. We do factor in the US supply, as we showed you. We put that into our global oil supply and demand model. But it's not yet sufficient, given our view, given all those things we just discussed. It is not yet sufficient to mitigate the decline in the non-OPEC supply production base. And therefore, that has implications for the oil price. And the blue line is our estimate of where oil prices will go to over the next 5 years. Anytime you see these types of spikes, it's a very dangerous period. It typically destroys demand as well, and that's why you get the oil price coming back off. Started to happen this year. We think it's got further to go, but ultimately the same drivers we have in place, back to that exploration chart, back to the early stage of unconventional exploration, the knowledge base, and that has to be built up. The appetite is building by the companies, but it's, from our forecasting point of view, it's not happening fast enough to destroy this positive outlook for a rising oil price. So I'm just really want to summarize there with some key points. First is, yes, the US was a very significant success case, but again, it added 6 billion cubic feet per day of gas onto a 60 billion cubic feet market. It's a very big chunk of supply very quickly without any means to get that gas out of the region. So it had an impact. In oil, maybe with the Bakken included, there's oil shale of up to 2 million barrels per day coming through, but that's onto a 90 million barrel per day oil supply market, which is growing. Therefore, it's much, much less impactful at the moment and doesn't make us overly concerned about the impact on oil prices. So yeah, obviously you can discuss OPEC on top of that with the oil side. What does OPEC do in reaction if oil shale was to start increasing beyond these estimates that we currently have? This cartel is actually very effective. You saw that in 2008, 2009, Saudi and Iran taking off very quickly, 3.5 million barrels per day of production over one summer. You saw the price go back from $40 back up to $80 per barrel by the end of 2009. It was very efficient. Took 9 months to hold back that level of supply, but it does happen, and it's something that will happen and would happen if that 2 million barrel per day became 20. So I'm just going to leave it there with those overview thoughts on how it plays into the global production market and take your questions.
Thank you, Oz. Let me start off with a question, because I know you guys, between your London office and New York office, you probably see, 30 or 40 companies 3 or 4 times a year, that sort of number?
Yeah, and that's what betting in all that information allows us to keep a firm handle on the actual numbers.
Yeah, and is it your impression that the majors are beginning to swing away from conventional exploration and focusing much more on unconventionals, or do they have balanced strategies?
It's as I see it, a lot of companies are diverging. So you had, if you use company specifics, Shell, Total, ExxonMobil, we're very early into Canadian oil sands, liquefied natural gas, and are pursuing that type of strategy. As I look at the BPs and the Statoils, they were still much less inclined to go after that as early as those other companies I just mentioned, and rather went for offshore basins exploration. Statoil is, as we heard this morning, very quickly catching up and going after this unconventional prize, but still in the learning phase. And that's really what's happening here. It's very much a learning process at the moment. Materiality levels have not yet been reached in a lot of the companies' cases. I would say in the BP case, it's clearly very, very different. BP still, as we look down on the companies, it's still going after the big exploration focused, big basins, big exploration programs, trying to do it a very unconventional way. So strategies are diverging.
Okay. Anybody else? Yeah, you're allowed a question.
I'm a bit stunned by your graph of the lifting costs. Does the slide before this one, does lifting costs just follow oil prices as a matter of economics, or?
That's more actual drilling costs, the amount of money you need to drill and complete and frack that next well. So, back to what Neil was saying this morning, you could have 1,000, 2,000 barrels per day from the Bakken, but when you go away from the sweet spot, you can go down to 50, 100, 200 barrels per day of production, which feeds into the ultimate reserves recoverable for that well. And if that's a small number on the denominator, you get a very high finding and development capex per barrel. So it's all related to the sweet spot, which is why the previous talk is really interesting, because mapping those sweet spots is certainly definitely the way to go.
Helio Santos from SafeKick. Just a curiosity, what's the lifetime of a typical well there? Because in the first 2 years the decline is sharp, but in total, what's the lifetime typically?
Yeah, I mean, it's a good question, and to be honest, I don't think anyone has that answer yet. I mean, the Barnett oil shales have been running for a couple of years. Barnett's been running for really 12, 13, 14 years, and it's still in the decline phase. There is debate over the shape of the decline, and it's still not an answered question. But you are going down, and theoretically, you should be going down to about 10-20% of that peak production, and it apparently will stay there for 30 years.
And that portion is too economic to produce.
Well, this is all done on a payback basis, because that's why you want the high initial production coming out quickly. You want your overpressured shales, and you make back that development cost per well quickly, and so you've made your money back, and everything else is profit on top. So it's
All done?
Ella from Informa Energy. Just going back to your slide on infrastructure, you said infrastructure was an impediment for development in this area. So my question was, is it just the pipeline construction part of it, or companies investing to build it, or just the availability of development on that front, or is it the more geopolitics of putting in new pipelines and things like that for companies?
a lot of those things, actually. I mean, that Europe and Asia, they tend to prefer long-term gas contracts, and suppliers will want a 20, 30-year contract in place in order to build the pipeline initially. So, I mean, companies would have to take some very big risks in order to say, sure, I'll supply you gas, 2,000 kilometers away based on an unsecured gas price. So that's the element that's not quite clear. So unless they get a very high price, they will not go ahead and build the pipeline. So it is a catch-22 situation, but not moving quickly. I mean, gas project sanctioning is definitely very slow in everywhere else outside of the US.
And is LNG terminals playing a role in this as well, in the transportation side?
Yeah, I mean, that's a crucial market development as well. But remember, LNG, liquefied floating gas, is 15% of total gas consumption. So it's very topical, but it's still a small portion of shifting gas from market to market. It will grow, but again, not fast enough to change overall gas market dynamics outside of the US.
Thanks.
Okay.